They will take, the people that are running the country will definitely take revenge. It'll be a form of several actions, but I think it's probably you're gonna see ISIS probably reform. It wouldn't surprise me. U.S. troops going to come out of Iraq, most likely. You're going to see ISIS, the Sunnis are going to try to do something. Iran is going to try to get back into Iraq in a bigger way, because they basically want to control from Tehran to Baghdad to Damascus to Beirut, all the way across the Mediterranean. And it's probably going to give them a greater position to do that.
But where's the risk premium then for oil? Yeah, we spiked Friday, but we've lost over 1% of that since then.
Well, if you notice, U.S. production's on a slowdown. We're only going to grow about 500,000 to 600,000 barrels a day next year. After 18 grew 1.5 million barrels a day. So we're slowing down. Producers are slowing down, developing this free cash flow model. So where's the extra oil going to come from? More oil is going to have to come from the Middle East. Who's going to control the Middle East oil besides Saudi? It's going to be the Iranians.
You think that their production, which has been whacked by sanctions, is going to somehow come back up?
No, when you put the 4.5 million barrels a day in Iraq with Iran, as they get control of Iraq, then they're going to control as much oil as Saudi Arabia. That's
you really believe that it's going to escalate to that level?
I think it will, yes.
I mean, they were at war for a decade. You think that could happen again?
Yeah, but who's running the country in Iraq
now? Well, Soleimani, let's not forget, was in Iraq. He was not in his own country.
Right. There's been a movement over the last several years since Shia runs Iraq now to get control and bring the two Shia countries together.
What would that mean for let's say that happens. What does that mean for the global oil market?
We'll probably see a higher price. We're probably going to see another $10, $15 on top of where it is now. So I'm probably more optimistic. There's no extra supply in the world. The U.S. is no longer that supply like they have been the last several years. So we're going to see a higher price for the price of oil. So Brent's going to go up $70 to $80 from 68 today.
We've seen the industry's output more than double. I mean, since you and I have been talking, I know you talked to Jim Cramer as well. I mean, you've gone from 5.5 million barrels a day to almost 13 million in the United States.
Yes.
And yet investors seem to have never cared less. Why not?
I know. What's interesting is that Pioneer has been, I hate to brag, but even though we have not caught up.
That's why you're on television.
We have not caught up with the S&P 500, but Pioneer is the best E&P stock for the last 10 years, last decade. We've gone from about 40 to about 150. Most people have not even returned investors' money to them. And so I think the change is they do not want us focused on growth anymore. We used to take every dollar that came into the company and add another rig. Today, we're announcing that we're going to increase production mid-teens over the next several years. We're going to add 2 to 3 rigs per year, but no more. The biggest question The biggest question I'm getting at this conference, Brian, is: are you going to add any rigs because you got another $7, $8 a barrel? And my answer is no. Everybody's answer is no. We're going to give it back to the investor. Then I think you'll see interest starting to happen over the last few weeks.
You guys have the cleanest balance sheets of any company out there. I think 0.3 times net debt to EBITDA. I mean, you've got companies that are trading at 2, 2.5, 3 times net debt to EBITDA. Does that mean you're going to use that cash flow to grow, or are you going to give that back to shareholders?
Yeah, I think you'll see a lot of these companies take that excess cash flow and reduce debt. There's about $200 billion of debt coming due over the next several years. $40 billion is coming due shortly through several independents. They're over-levered. They got trapped, and those are the ones that are going to take the excess cash that they're getting and apply it to debt reduction.
Will $63 a barrel save the industry from a wave of bankruptcies, which might be coming?
It probably will if it continues. If it continues like I predict, it'll probably stay there several years. That I think a lot of those companies, they want to get their debt down, and then they have to merge up. We'll have to consolidate. We still have too many independents in this country. Too many public independents, too many public service companies. There's got to be consolidation at some point in time.
Well, it's going to happen one of two ways, right? Deal making or bankruptcies. Which one do you think it's going to be? Or maybe it just doesn't happen.
It'll probably be more deal making because, like I said, I'm optimistic about oil. Oil's going to stay up there, especially what happened last weekend, and you're going to see more consolidation.
But don't you think the reaction of the Anadarko deal, which was not positive on the Oxy side, could hinder deal making? Or is that more of an, and I'm not asking you to bash Occidental, because they took on a lot of leverage to do that deal. Maybe that was just a specific situation.
Yeah.
The reaction wasn't great.
No. It was all about leverage. Leverage in this industry, I've learned from 1998, we were a $5 stock at that point in time. We took on Mesa's debt, Boone Pickens' debt, and it almost cost the company. And so ever since then, I hate debt. I don't like debt. Nobody should have debt in this industry. It's not an industry to have much debt. And
But there's
so,
a couple $100 billion. Nobody listened.
I know. Oxy
There's
took
like 6 times more debt than net income.
I know it. It's all left over from the 12 to 14 time period. It all got pushed forward, 15, 16, 17. It's getting pushed forward again. And so the markets, nobody wants to own the assets. The creditors don't want the assets. The banks don't want to own the assets. So they keep extending the debt out. But eventually, you have to have enough cash flow come in, reduce the debt, and then those companies need to consolidate or merge in with other independents.
This is a little bit of an odd way to think, maybe, and we'll wrap it up with this. Your break-even cost is in the low $20.
20s.
Low 20s. I mean,
Exactly.
Most of the industry would love to have that. So in some weird way, and by the way, I got this from the Saudis at the last OPEC meeting because I know you're, by the way, the only CEO I've ever seen at an OPEC meeting. So I was glad that you made it over a couple years ago. Do you benefit if oil prices drop? Because your cost of production is so low, you can survive where others can't.
We benefit from a standpoint of the competitors will go out of business, but I'd rather have an
That's
environment.
kind of what I mean. I mean,
Yeah.
I'm not trying to be a grave dancer or something, but it's the Saudi position is because their cost of production is so low, $3 a barrel, whatever it is. I know they got social costs, but their actual production cost is so low that maybe if prices fall, they look proportionally better.
Yeah, but they really don't want that scenario, as you know. They need $80. That's why they took Aramco public. They need $80 a barrel to balance their budget. They're too dependent upon oil. The Crown Prince is trying to change that. I'd rather see a stable $60 to $70 oil price market versus a lower oil price market. We have to get investors interested into our sector again. And the only way to do that is give them money back, either in buybacks or in dividends, whether it's base dividend, variable dividend. We have to return capital back to the shareholder. We took too much capital from them.
Return of capital, maybe not on capital.
Yeah.
Scott Sheffield, a pioneer. A really great discussion, long, wide-ranging. We appreciate your time.
Thanks,
Scott.
Brian. Great
Thank
to
you.
see you again.
Thank you.